Yo, what's up, guys? In this video, we're going to be looking at 10 dividend stocks that once you buy them, you never need to sell them. They are that high quality. I have very carefully selected these stocks because for me to claim you should just never sell them, they got to have some very high quality fundamentals. Some of these I do own, a lot of these I don't own. I wanted to try and introduce you to some new stocks. By the way, my name's Nathan Robert. I'm just a college student, so I'm not an expert. This is a financial advice. I just love talking about stocks. So if you like this kind of stuff, please subscribe if you're new. I'd love to see you here again. And drop a like on the video for me if you haven't already. And let's get into the first stock. But I'm going to be showing you the main highlights about each one of these stocks. And like this first stock right here is ticker symbol UNM. You've maybe not have heard of this company before, but this is a disability insurance company. And check out this stock. Even if you buy it right now, you get a 2% dividend yield. And look at the PE to the left of that. They're trading at 10 times net income. So a very fair valuation, in my opinion, for an insurance company. And look at the dividend right here. Right now, they pay you 42 cents every single quarter. They're about to raise it actually too. So right now, their dividend costs 42 cents. And look at the EPS every quarter. I mean, it's well over $1 every single quarter. And the dividend only costs 42 cents of that. So they have like a 30% payout ratio for a 2% dividend yield. I'll just show you the numbers for yourself. So the net income did fall 52% year over year, but it's no big deal for the insurance stock because look at 2 quarters ago, it was 645 million. Anyway, let's just not give them the benefit of the doubt. Let's say they make 250 million of net income a quarter, which it's actually way more than that. But let's just say they make 250 million a quarter. Look at that. They can easily afford the dividend. It only costs $77 million. So that's what I really like about UNM. They're also doing crazy stock buybacks. Look at that. In the most recent quarter, they bought back 200 million of stock, then 500 million, 200 million. So this is a company with a lot of extra money that they're returning to the shareholders. I love shareholder friendly companies. 2% yield. And no way, I actually didn't realize that. They have bought back 8% of the company since just last year. I mean, that is incredible. So you get 8% of your money back in stock buybacks and you get a 2% yield. So anyway, UNM seems like a very cool company that I believe you should just never sell this one. Now, again, it might be tough to buy this one at all-time highs, but quality companies deserve to be at all-time highs. And this is one that I believe is very high quality. And you get a nice yield. Even if you buy them right now, the PE is fair. That's why I wouldn't mind buying that stock at all-time highs. The PE is fair. So also in this video, I'm trying to go over stocks that are in a bunch of different sectors. I don't want to go over a bunch of insurance stocks and a bunch of oil stocks. I'm going to try and do one stock with each sector. So this next stock right here is Chevron, the one owned by Warren Buffett. It's like 6% of Warren Buffett's portfolio. But if you buy this stock now, you get a 5% dividend yield and the PE is a 15, fair valuation for an oil stock, but you get a 5% dividend yield and that's huge. And you also get exposure to oil, which tend to do good whenever there's war fears, currency fears, or like inflation. Oil sometimes does good in that environment. But anyway, let's look at this one's dividend. You get a 5% dividend yield right here. Let's just go look at the numbers right here. So yeah, the net income is down 36% year over year, but that's because of the price of crude oil. But remember this, they're making easy 3 to 4 billion of net income every quarter, sometimes more than that, depending on the price of oil. Make it 3 to 4 billion of net income a quarter, and the 5% dividend yield only costs $3 billion a quarter. So yeah, that 5% yield is huge. They're also a huge buyback company as well. Look at that. You now own 5% more of the company than you did a year ago. I mean, that's incredible. There was 1.85 billion shares a year ago. Now there's only 1.75 billion. So you now have more ownership in the company than you did 1 year ago. Yeah, look at this. Chevron is literally spending more money on buybacks than they are on their dividend. Look at that. 3 billion, 4 billion, 4 billion. So Chevron is another shareholder friendly company that I would happily be comfortable with just holding on forever. No real reason to ever sell out of Chevron. They just have so much extra money that they're returning to the shareholder. So that's Chevron. All right, so the next stock I think you should never sell is PepsiCo, and this is a huge company trading at a discount right now. And that's because the earnings have slightly fallen, the dividend payout ratio is a little high, but I trust Pepsi that they're not going to have to cut their dividend. Even though the yield is a little high, I'm just going to assume there's going to be slower dividend growth. Like right now, if you look at the yield, you get a 4.3% yield on a quality company as Pepsi. I mean, that's huge. So I don't think they're going to raise their dividend too much, which I think is the good news because the dividend payout ratio is a little high, but let me show you this right here. If you average out the 4 quarters, like look, they made 3 billion, 3 billion. So they're making like 2.2 billion of net income a quarter. So remember that number. Pepsi makes on average in 2.2 billion of net income a quarter. Let's go see how much their dividend costs. So this is my only concern. The dividend payout ratio is a little high, but I'm just going to assume they're going to be some slower growth. They're going to keep their dividend payout ratio or keep the dividend payouts at 1.8 1.8 billion or 1.89 billion. They're just going to raise their dividend by 1 penny a share. So anyway, I think Pepsi's going to have some slower dividend growth, but that's okay because they have right now a huge yield. And look, they're also doing a little bit of buybacks. I mean, nothing huge compared to the dividend, but they are buying back their own stock. They're definitely not diluting you, which is the great news. But yeah, Pepsi, I think I trust this company and their brands to have a safe dividend payout ratio, even though the dividend growth is going to be slow. I like Frito-Lay, I love Cheetos and Doritos, and I love a lot of their products. I love Pepsi. So anyway, Pepsi, I think, is a quality company that is trading at a discount. The risk to reward actually looks pretty fair on them. I love their brands, and I don't think they're going anywhere. All right, guys. So for this next company here, we have an aerospace and defense company known as Lockheed Martin (LMT). With this stock, you get a 2.74% dividend yield, and the forward PE is a 17. So they're trading at a pretty fair valuation. And look at how diversified their revenue streams are. They're in aeronautics, rotary and mission systems, missiles, and fire control, and space. So they're in a lot of different industries. Like, let's see how their space revenue is doing. Well, that's down 2%. Aeronautics is up 3. Rotary's up 4. So again, not crazy growth with this company. Like, most of their business are growing like single digits. But check out this right here. Look at the yield. You get a 2.74% dividend yield. The dividend only cost, or it's $3.30 a quarter. And look at the EPS in the most recent quarter. It was $7. So they can easily afford that dividend. Look, that was actually a pretty good quarter. Now, if you look at the quarter before, it says it was only 500 million. That was technically a one-time adjustment because they've never had that low of a quarter. So anyway, on average, let's say this company makes 1.6 billion of net income a quarter. So 1.6 billion of net income a quarter, and the dividend only cost 800 million. So that leaves them with a lot of extra room to return to shareholders. And guess what they're doing? They're spending more money on their stock buybacks than they are on their dividends. So that's great news, I think, about Lockheed Martin. We look at the total common shares outstanding. Look in the left, there's only 233 million shares. Let's go to 2019. I mean, there was 280 million in 2019. There was 280. Now there's 233 million. So Lockheed Martin is literally buying back their own stock like crazy. I mean, we can see that they're spending like $1 billion of net income every quarter buying back their own stock on top of the 800 million they return to shareholders in the form of a dividend. So this is an aerospace and defense company that I think is a great just buy and hold for the long run. No reason to ever really sell out of them. All right, so for this next stock here, you've probably never heard of this one before, and this is a healthcare REIT. They specifically focus on senior housing care facilities, and check out the stock price appreciation of this stock. So this is actually a REIT, a real estate investment trust, which means most of their assets are real estate. And look at the yield you get with this company, a 4.66% dividend. So you get a very nice yield. And here's the most impressive part about CareTrust Realty. Look at the growth of the sales. Now, this is impressive. It's up 53% from the previous year. That is crazy growth. And look at this balance sheet. That's what's crazy. The net debt on this company is so low. It's so low. And let's go do a dividend payout ratio. So remember, this is a REIT, so they do have to pay out most of their income in the form of a dividend. But check this out. This is what you want to look at. This is known as the core FFO. They made it was up 46%. They made $71 million in the most recent quarter. And that's just expected to keep on growing. But let's see how much the dividend costs. Yeah, the dividend only cost 50 million or 55 million. So they can easily afford the dividend, and they even have room to raise the dividend. And this company has been one of the best performing REITs as well. So this is a healthcare REIT. So here's what CareTrust actually is. They develop and lease, they do triple net leases of skilled nursing, senior housing, and other healthcare related properties. And check this out. This is the most impressive part. Like I said earlier, the net debt to annualized EBITDA. I mean, 0.5x. They could pay off all their debt in half a year. I mean, that's super impressive. And you get the 5% yield, $5.4 billion market cap. So anyway, I think this is a very nice stock. Oh, here, I guess, are some of their properties or whatever. But anyway, let's get into the next stock. I think you should never sell. All right, so for the next dividend stock here, I actually own this one in my Roth IRA. My Roth IRA is small. It's only, $1,100. I've had it for exactly a year. Check that out. So anyway, my main holding in here, and this is funny, my main holding is Mainstreet Capital. So this is a BDC, a business development company. They do like first lien loans. Sometimes they have like preferred shares of stock. But anyway, I don't have a huge chunk of my portfolio in this stock right here, but this right here is a monthly paying dividend stock. And I love this. They even make so much money They make so much money that sometimes they pay you twice in 1 month. So their normal dividend is 25 cents a quarter. But check this out. In between these two 25 cents, or no, 25 cents a month, in between these two 25 cents a month, they paid an extra 30 cents. I mean, that's huge. So when you don't include the special dividend, their normal dividend yield is a 5.3%. You get a 5.3% yield. The PE ratio, the forward PE is a 13. So a pretty fair forward PE. And look, it's had some decent stock price appreciation. But let's go see, is this dividend safe? So check this out. Their dividend costs 25 cents a month. So that's 75 cents a quarter. If we go to the EPS right here, it's well over a dollar every quarter. The dividend costs 75 cents a quarter. They're easily making over a dollar a quarter, and that's how they're able to pay out these special dividends. And let's just look at that in the net income. So they made 116 million of net income in the most recent quarter. On average, if you average it out, they're making like 100. We'll just call it 130 million of net income a quarter. So let's say on the average quarter, they make 130 million. And look at that. They're over 5% dividend yield, cost only $83 million. So yeah, that's what I really like about Mainstreet Capital. They sometimes do those special dividends, which are always great. So yeah, Mainstreet Capital, I own them in my Roth IRA. I might be biased because I own them. But yeah, I think it's also smart to hold them in a Roth IRA because they don't pay a qualified dividend. All right, so the next stock I think that you should never sell is actually McDonald's. And I know we already went over a food company, Pepsi, but McDonald's is really a royalty and real estate company. Whenever you go spend $100 at any McDonald's, $4 of that goes back to the parent company as a high margin royalty. And for 80% of the stores, they own the land under that. So every store, every franchise is also a tenant that pays the parent company rent. So look at this net income right here. And you technically want to look at the operating cash flow for this company, but let's just look at the net income because they have a lot of real estate assets. They add back the depreciation, the amortization. But anyway, they're making $2 billion of net income a quarter on average. So just under that, we'll just say $2 billion of net income a quarter, and their dividend only cost $1.27 billion. So they can easily afford the dividend. And McDonald's is also a crazy share buyback company. They're spending a lot of money on stock buybacks as well. So McDonald's is really a nice company that you just want to own for the long term. They're recession resilient, recession resistant almost. In 2008, they were the best performing stock in the S&P. They didn't really dip in 2008. Yeah, here's 2008 right here. They actually acquired a bunch of new land in 2008 for the cheap price. In a recession, people will probably stop going from Texas Roadhouse and probably go to a McDonald's instead. So I also will say I might be biased. I do own a lot of McDonald's. Check that out. They're our third largest holding in here. Yeah, we got 13 shares of them, and it's a $4,000 position. My realistic thoughts on McDonald's, you should just get 7% of your money back a year. 2% in dividends, 2% share buybacks, 2% same store sales growth. So anyway, McDonald's, great buy and hold for the long run company. One of the best charts I've ever seen for a blue chip stock that steadily, doesn't have huge dips. It just steadily climbs up and up. So anyway, McDonald's is a stock that I really like. I think you should just hold that one for the long run. No reason to ever sell out of McDonald's. All right, so for this next dividend stock here is one I just bought another share of. So this is United Rentals. You just rent a bunch of stuff from this company. They have the largest market share. Look at that. I just bought another share for $715. It's at $708. So I didn't time that too great. But here's the thing about United Rentals. I really believe this is going to be a dividend growth monster. Look at the net income. Now, it was down in the most recent quarter because they had to pay a one-time fee, for a termination fee, because they couldn't acquire a company. But anyway, on average, they're making, let's say, 600 million a quarter, 600 million plus of net income a quarter. So United Rentals makes 600 million plus a quarter, and the dividend only cost $118 million. So very low dividend payout ratio. And since it's so low, they're spending literally double, triple what they're spending on their dividend on stock buybacks. That's the most impressive part about United Rentals. They literally have upped the buybacks to 400 million a quarter. So if we go to the total common shares outstanding, there's only 65 million shares in the most recent quarter. If we go back to 2029, let's go to 2019, there was 75 million shares. So 75 million to 65 million in 5 years. Wow. That's impressive. So United Rentals, oh yeah, let me show you the yield as well. Now the yield is kind of low. It's a 1% dividend yield, but the growth is insane here. They actually just started their dividend in 2023. It's $1.48. Now it's $1.80. or $1.79. So I think United Rentals is going to be a great compounding machine in the long run. I do own them, so I might be a little biased, but I don't even mind buying that one right now. Oh, let me show you the PE ratio as well. The PE is very fair. Yeah, so the PE is a 17, or the forward PE is lower than the TTM PE, so they're expected to grow their net income. So anyway, United Rentals is a very cool company. And also, here's one huge growth driver for the company. If we look at United Rentals specialty rentals, so the specialty business is only 30% of the business, but it is growing. It's up 22% from the previous year. So it's seeing some very nice growth if we kind of look at it on an annual basis. Their specialty rental revenues going up and up and up. And also the general rentals, it's seen some slowing growth. Like it's only up 1% from the previous year, but it's still growing, which is the good news. But the specialty business is what's huge there. So yeah, United Rentals, great company in my opinion, great dividend growth company. Let me see the payout ratio right here. So yeah, 1% yield, 16% payout ratio. I think it's even lower than that. So yeah, that's United Rentals. All right, guys. So for this next stock right here, I think this one is a hidden gem that nobody knows about. This is ticker symbol GFF. This is Griffon. And check out the yield. It's a 1% dividend yield. I get it. But look at the forward PE versus the trailing 12 months PE. For last 12 months, it's a 14 PE, but the forward PE goes to a 12. So they're expected to grow their net income. The market cap's only a 3.3 billion. So I think there's a lot of room of upside for this company. Now, again, the net income is expected to grow, but right now they're easily making 50 million plus of net income every quarter. It's actually way more than that. It's probably like closer to 60 million, but look, they're making 60 million a quarter. The dividend only cost 14 million. If you're wondering like, hey, why did it go up to 100 million these 2 quarters? This company actually does special dividends as well. But that's also not the best part. The best part about this company is actually the share buybacks Griffon does. They have bought back 6% of the entire company from the previous year. So look at that. They're only spending, 10, 15 million on dividends a quarter. Look how much they're spending on stock buybacks. I mean, that's really impressive. So yeah, again, if we go to the total common shares outstanding, you now own 5% more of the company. 2019, there was 46 million. Now there's, well, I guess it started at 46 and they diluted you, went up to 56. And now look at those year over year. Dang. So they've bought back a lot of the company. Anyway, I think this one will be a good dividend growth company now. They are related to the home builders. The stock moves like the home building stocks, but it's appreciated more when the home builders go up and falls less when the home builders go down. So yeah, $3.3 billion company, 1% yield, low payout ratio, major stock buybacks on Griffon. So this is one I have in my never sell watch list because I think you should never sell that one, even though this is probably one of the more risky ones on the watch list. Only a $3 billion market cap. I love the dividend growth, the low payout ratio, and insane buybacks. So yeah, that's Griffon. All right, guys, I just realized if you look at the top right, my phone is on 1%. So this is the perfect time for me to get into the final dividend stock that I think you should never sell. And by the way, if you found any value in this video, found a new stock or something, please drop a like on the video. I always try and deep dive into the numbers, show you the numbers for yourself. Like, look, this is how much net income they're making. This is how much their dividend cost. And this is all the money they have left over to do share buybacks. So I just like showing you all the important numbers. And I'm also completely transparent with all my portfolios. If you want to see a stock portfolio update, check out my last video up here. But let's get to the final dividend stock that I think you should never sell. And again, please drop a like on the video for me. So let's get into this. So this is TROW Price Group. Now, this is an asset manager. And if we go to the yield here, you get a 5.5% dividend yield with this company, and the PE is a 10. So they're trading at 10 times net income. The balance sheet's phenomenal. They actually have no debt, no net debt, obviously, in a ton of cash on hand. You know what? Let me just go to the balance sheet and show you that for yourself. So this company has a $2.84 billion of cash. So $2.84 billion of cash. And yeah, the total debt is negligible, 44 million. And it actually just went down from 100 million. So 44 million of debt, 2.8 billion of cash. So actually over 14% of the market cap is just their cash on hand, $20 billion market cap. So here's the net income. It actually had a one-time adjustment. It actually went up. But anyway, this company easy makes, 500 million of net income every quarter. So remember that. This company easy makes 500 million a quarter. Their 5.5% dividend yield only costs 290 million. And guess what? Just like a lot of the other stocks on this list, I look for companies that are doing buybacks. These are the best companies that I think will have the best total return. The companies with low dividend payout ratios that leave them money to do share buybacks and reinvest in the company without diluting the shareholder or having to issue debt. And look at that. They just spent 200 million on buybacks. So TRO price groups looking insane. They buy back their own stock, of course. So anyway, that's the list of stocks you should never sell. Please let me know what you think in the comments. My name's Nathan Robert. I hope you have a great rest of your day. And if you leave a comment, I promise I will respond to every single one of them. Let me know if you made it this far in the video, and I'll see you in the next video. Have a great rest of your day. Please check out the videos up here.